afternoon, welcome to all our viewers. You're watching Countdown right here on Bloomberg Quint. A somber mood for the markets as the indices once again take the tip down for the Nifty as well as the Bank Nifty, which is now approaching that crucial 25,000 mark yet again. But let's quickly take a look at what's been happening in terms of the headlines. It's a choppy expiry session for the markets. The Nifty trades around 11,000. The losses are led by housing finance companies yet again. Despite assurance from the RBI, correction in the housing finance companies continues. Most stocks have fallen to multi-month lows. And aviation stocks continue to correct after the government imposes a 5% levy on aviation turbine fuel, thereby adding the cost pressures. And the government is forced to extend the subscription period and cut issue price for Garden Reach Shipbuilders IPO after it received a tepid response in the first 3 days. But let's tell you what's happening in the markets. What are the moving parts? It looks like another somber day, Neeraj. Yeah,
another somber day. You could look at the Nifty Bank being off slightly from the day's lows, but frankly, it doesn't yield any confidence. 0.5% odd for the Nifty. The Nifty Bank down about 0.85%. Some gyrations would happen considering it's expiry day as well. But for now, under a bit of pressure. Actually, if we can get the BSE mid-cap, I mean, they will not speak about it, but at some point of time, the BSE mid-cap index MRR, and you will see the kind of falls that have happened into the NBFC stocks. That's really been the trend line in today's session. However, this index is down about 1.5%. That's cool. And the heat map will show you financials have pressure on the large cap end as well because, okay, this is the MRR for the BSE mid-cap index. And look at this. As I said, they will not speak about a lot of these, but just want to highlight the point that it's filled with some of the NBFC stocks. However, the heat map, just get the heat map once before I hand it over to the day. We're talking about what's happening at the broader end of the spectrum. Yes Bank down about 6%, India Bulls about 6%. Quality is not being spared either. Bajaj Finance down about 3%. Maruti, some pullback in the last couple of days being sold into, down about 2.5%. Kotak Bank about a couple of percentage points. But even Stevens on the breadth so far on the Nifty at least, even though we're down about 0.4 or 0.5%. Titan and some of the other consumption names like Asian Paints are giving some support. SBI marginally higher, Tata Steel marginally higher. But so the sentiment certainly stronger out here and the losers as opposed to the gainers. But the broader end of the spectrum.
Well, you did half my job for me, Neeraj, but I'm going to still take you through some of the specific stocks that are having an impact in today's session. So, like Neeraj highlighted, the mid-cap indices have seen cuts of almost about 1.5%. But specific stocks where the pain and stress is more, a Sri Infra Finance, you've seen that stock under pressure for some time now. Along with that, you have an Edelweiss, which has seen a significantly sharp cut in today's session of 11%. Remember, this is just exaggerated. You had Rashesh Shah making comments like the industry is likely to face some amount of stress for the next 3 to 6 months. So that probably did not send out a very positive note. GM Financial is down 7% as well. Some stocks with regards to the duty hike impact. On the negative side, you had Jet Airways and the entire aviation space facing some pressures. Havells is down in trade today by about 3.5%. On the positive side, for tyre companies, JK Tyres, though the management did come on the channel and say it's not a meaningful upside for them because the supply is anyways domestic, though the stock is still up about 3.5%. Voltas, again, down about 3.98%. In terms of specific gainers, Zinsar Technologies is doing okay for itself. You've got a Delta Corp up 3%, and a Prestige Estates from the real estate pack is doing okay. And volume buzzers, lastly, before I go ahead and discuss what's happening in the futures and options space with Agam, you've got Reliance Capital trading 85 lakh shares. The stock is down and out in trade today by about 5%. Yes Bank, 7% cut on the stock, and NIT Tech trades about 10 lakh shares, losing about 3% in trade. But it's expiry day. The last half an hour is going to be extremely crucial. We're going to be closely watching out for rollovers, particularly on the Bank Nifty, considering the kind of sharp fall we've seen in the index. Agam joins in with more details. Good afternoon, Agam.
Well, Devina, over the last couple of days, everyone has been watching out for the 11,000 mark. That's exactly where the Nifty is. Well, up and down about a few odd points here and there. But this is a crucial juncture here, considering the only option out there in the markets which has the most amount of open interest currently is the 11,000 put. And you know, as things stand, we're still seeing the Nifty at around that same level. The rollovers have picked up to around 51%. But again, with an hour left, I really am going to be curious about where we see these rollovers. At this point in time, they seem extremely low, considering we're used to rollovers of around 65, 70%, 75% in terms of, the previous few series. So this certainly means that there is a lot of, resistance building in terms of the fact that the traders do not want to carry their positions forward. We're seeing rollovers at 51% for the Nifty. The Nifty banking rollovers also just round about there at 48%. And these numbers at this point in time, with just about an hour to go for expiry, look extremely low. Let's bring up the volatility index, and that has been largely flat. In fact, it's come off to a certain extent. This perhaps is a surprising one, but this is also likely to do with the writing that we've seen in the September series. And speaking of the options, let's pull up the ones which have the most activity. And as one might expect, we're seeing more and more activity around the 11,100 call. That's where we've seen writing, a little more writing coming along in the 11,000 call as well. So watch out for these ones. And when it comes to maximum open interest, has that changed, considering we've seen the transition into the October series, and that is going to tell you a different picture. So even though currently your maximum open interest is now at around 11,100, your lower level, seems at this point in time when it comes to the puts is at 11,000, but we're starting to see more and more build up around the 10,800 and 10,900 levels too. Finally, let's talk about a few stocks out there. Jet Airways is right at the top. We're seeing substantial shorts there. We have Yes Bank, and look at the rollovers at 86%. This is largely towards the short side. Yes Bank is the other one. Well, we are seeing substantial weakness here, edging towards the mark of 200. Bata India on the gaining end is what's seeing gains. Well, rollovers at 63% there as well. And Dipan Housing, once again, where rollovers stand around 65%. More weakness there, but this is also largely due to the fact that, well, Dipan Housing has moved out of the F&O band. So let's wait and watch what October holds for some of these counters. But more pressure on the indices and more pressure on the NBFCs.
Right, Agam. Thanks very much for that. So that's a quick update and a snapshot of the futures and options space and the kind of activity we are seeing ahead of expiry today. Just a few stocks before we go ahead to our guests. Sri Infra, like I highlighted before, now is down 14.5%. Though we have seen a slight bit of a recovery coming back into Bank Nifty, the index is now down about 0.8%, so under 1% from being down almost 1.2, 1.3% in early trade. So some pickup there. For the Nifty, we've reached 11,000, trading around 11,000 yet again. So the last 3 or 4 trading sessions, it's been bouncing in and out of this range. There's not been a convincing breakdown from these levels, which is heartening to see. And the fact that those put writers at these levels are holding strong ground. Let's bring in our expert then, Shailendra Kumar, Director and CIO at Narnolia Securities, joins us on the show right now. Shailendra, thanks very much for taking out the time. Just want to know what kind of a setup are you viewing for the markets right now in terms of being very stock specific, taking index calls? What shall one look at before taking a trade?
Yeah. So Nifty is down by about 700 points from the peak a month back, right? Now, that means Nifty has fallen only by 6%. But the kind of atmosphere which is there in the minds of market participants, as if it's a full-blown bear market, right? Primarily, sentiments are emanating because the small and the mid-cap segment of the market is in a kind of a declining mode since the beginning of the year. If you look at the Nifty per se, the fall is 6%, number one. If I go back 5 years, 2013 to 18, last 5-year rally, Nifty has behaved in a very disciplined manner, I would say, in terms of valuation. So every time it goes to 18 times 1 year forward, it bounces back and it goes to 24 times, right? Now, if that kind of envelope is going to remain there for Nifty in going forward, then surely anything below 11,000 would be a very appropriate level to start accumulating stocks again. So last time when we spoke, I was a little concerned about the risk reward becoming disfavorable. But at below 11,000, surely the odd becomes favorable to the buyers. Having said that, the question is like whether the valuation envelope which was there for last 5 years will remain will be going for the next 2-3 years or not. Now, every time bouncing from 18 time P primarily rested on 4 theses, right? First was the bond rate was declining. So 2013, if you remember November, the 10-year Indian bond was 9.3% or thereabout. And it kept on falling, and we were a year back in July of 2017, we were like 6.4 or 6.3%. So that bond yield getting down continuously for 4 years helped the PE becoming, remaining higher. Also, the domestic macro, because of crude and other factors, were very robust. Thirdly, the policy regime was very stable, and there was a hope for earning revival. The 4 factors which made the PE remain higher than 18 time 1 year forward. Now, if I look at today, currently, surely 2 of the jing has gone out. So no longer the interest rate favors you. So the bond yield last year was 6.4%. Now it is like 8% plus, right?
Right.
So the bull market, so there is already a bear market happening in the bond market. And secondly, because of election overhang, you don't have so much of a policy certainty than what you had, say, a year back or 2 years back, right?
True.
So, yeah.
No, so
yeah,
the question is this, Shailendra. So I take on board some of the points that you're making. Where I differ marginally is that, yes, the correction has largely been in the mid-cap and the small-cap end of the market, but some of the larger mid-caps have corrected quite significantly. Now, we've seen that happening in the NBFC space predominantly, but it's spread to other names as well. Some of the large quality paper on the NBFC side has corrected anywhere between 30% to 50%. And these are not names that are necessarily having an ALM mismatch or a credit risk in their portfolio, but they have all been taken down. That shows the sentiment of the market. You believe people will put in money to work at these levels while the sentiment is the way it is?
Yeah, right. So, see, pessimism, pessimism is always good for a buyer, right? So, you can't get in a roaring bull market, you don't get a SDFC bank at a 2.5 time 1 year forward earnings. So, that's for sure. So, having said that, look at the NBFC, which you mentioned it right now. There are 3 ways to look at it right now. One from the angle of interest rate cycle, the other from the angle of credit cycle, the third from the valuation angle per se. Now, as I said, the interest rate cycle for sure is worsening. The bond market is in a bear. So last 1 year we have from 6.4 we have gone to 8.1, and because the US 10-year is already 3% plus, and the way US Fed has anchored the participant, people are more comfortable with something like going to 4% 10-year in US in say 6-9 months than anything less than that. Now, in a scenario where it will be 4% plus 10-year in US, you can't think of a scenario where Indian 10-year will be less than 8%. So 8% is here, and it will remain here for quite some time. So that's the one part of it. Like, naturally on the NBFC side, particularly where the asset liability is not, at least for the shorter term, because say housing finance company particularly, which has gone the 50%, 30% kind of a brunt. Look at their balance sheet. They finance asset primarily for 15-20 years. Whenever they lend for a housing mortgage, the loans are for 10 years, 15 years, 20 years. But those assets are getting financed through 1 year, 3 year, 5 year papers, right? So there is inherently asset liability mismatch. Now, in a worsening interest rate scenario, there surely will be happening a circumstances where the credit spread will start behaving differently for these names, right? Secondly, the kind of inflow which is coming to the bond market, right? So FII, if you look at the foreigners, 2018 will be the year where the net sale by the foreigners will be highest among any calendar year since the time they started investing into Indian debt papers, right? So in terms of buyers in the bond market has almost squeezed away in terms of foreigners. Locally also, if you look at the mutual fund numbers, there are hardly any inflow towards the fixed income side of the markets.
Yeah, Shailendra, due to paucity of time, I really can't get into such a detailed discussion. But to sum it up, would you reckon that there is more pain for some of these NBFCs, or do you think that some of them provide attractive opportunities?
Yeah, so see, what I would suggest an investor is basically, the larger name like HDFC, they have got to a valuation where they were, only bearing to, if you remove the 2009 calendar year, HDFC Limited, I'm saying the HDFC Limited, never traded at a valuation of 1 year forward or a 2 year forward 2.5 time price to book, right? It's a franchise. Every businesses that they have started in their life journey, whether bank or a insurance or a AMC, they all have done wonderful, right? So you can't doubt the management pedigree. You can't, they have handled so many ups and downs in the business cycle. So you can't doubt today that this kind of a different interest rate and credit cycle environment will suddenly make HDFC management not competent enough to manage the volatile times ahead. So there are names. Surely go for the larger names because you have a management confidence going forward, right? Don't go for some names where the risk reward ratio, so don't go for the names where the higher risk, higher return, exists. So go for the larger name, but I'll surely try to, go and buy in this pessimistic market for sure.
Yeah. Shailendra, just one last question, on a stock which is now sub 200, I mean, around that mark, we'd seen a Yes Bank, being beaten out of shape, the overhang of the succession of Mr. Rana Kapoor. Does one completely wash their hands off this stock if they have it in their portfolio?
Yeah, so like, see, there are two sides of it. Like, for sure, we are like bearing Rana, Kapoor, like, for last three, like since the time Yes Bank started, you had only one name, leading the bank from the front. The kind of the management depth you have seen in other names like HDFC and other, you don't have that kind of a name confidence for Yes Bank. At least I don't have in that order. So surely I would like to see how the event unfold, what the RBI does for the request they have made for extension of the current CMD for some more months. So I would not be dabbling just now on the price. Surely it's a good watch because the liability franchise that they have built is very attractive for somebody to at least look at the stock.
All right. We'll leave it at that, Shailendra. It was a pleasure chatting with you and getting your views on the show. So HDFC Limited is one stock that Shailendra sees value in at this current point in time. The stock's down about 2%, 1731. Yes Bank on the other side is down almost 7.5%, which brings me to the bank Nifty, which has now seen a sharper cut, now down almost 1.2%, after seeing that small spike that came in, just as we started the show. So approaching the 25,000 mark for the bank Nifty. It's now down 300 points. Nifty is a good 20 points under 11,000. So, looks like we're in for a rough expiry. It's going to be volatile, so probably just brace yourself for that.
It doesn't look too pretty. Let's wait and watch if this succumbs further. We'll get in a bunch of other market guests as well. But also important to talk to a couple of corporates which might have been impacted as a result of the changes in the duty structures that the government announced yesterday. Remember, for the air conditioning companies, the duties have been raised, but the duties on compressors have been raised as well. And from whatever little we read from the analyst community, a lot of these compressors are imported by companies, and therefore the cost goes up. So whether or not it's a net positive or a net negative remains to be seen. The market certainly wants to believe that the duty structure change isn't, it's not positive. It may not be big negative, but definitely not positive because of the duty on compressors. And I think that's the moot point. We'll try and get the management of Blue Star predominantly to talk about this. Remember, all of these stocks have corrected and corrected quite a bit. Dixon and Amber are different kettle of fish because they are the ones who are manufacturing, and companies, instead of importing the units, might actually ask these companies now to manufacture because that might be cheaper. So the order books of Dixon and Amber might only go up. These are contract manufacturers, but the owners of brands might have a problem. So that's one. The other set are the footwear companies. Now the customs duty on footwear has been increased to 25% from 20% earlier now. The question mark is whether that impacts some of the existing players in the Indian footwear industry. A quick chat with Adesh Kumar Gupta. He's the chairperson, executive director and promoter director at Liberty Shoes. Mr. Gupta, thanks so much for joining in. This second such measure that has happened in 6 months' time which aids the local footwear industry. Is this a big positive or is this a net neutral?
Well, I think, let me put it this way, I think it's only a positive because, if you look at 6 months story before, the custom duty was increased from 10 to 20%. And now there is a further aiding or another 5%. So the whole idea is basically to discourage imports. At the same time, it is there also to promote under Make in India, the domestic industry. So I think it's a good news for brands like us and also for the domestic industry. On behalf of the CFLA, which is the Council for Footwear Industry in India, which I represent as a chairman, we have been pleading with the government, since years that, this has to be, changed. And I think now the time has come that the government has finally done the last efforts to increase the duty. So while, the government is going to benefit, largely from the tax benefit of the customs on import of cheap shoes or shoes from China or other countries, it's also time that the government should think that, the long-standing demand of the GST on shoes above 1,000 should also be reduced to 5%, because when the government is going to get benefit from the custom duty, it's imperative that, the domestic industry needs further to be incentivized by way of reduction of GST, which is also a long-standing demand. So I believe that for the export community and also for the domestic industry, it's a good news that, we are having higher custom duty for imports.
Do you see a material increase in your overall sales? I mean, coming off from Q1 where you had your net sales go up by about 19-20% Do you see a material increase from that?
Well, what we are seeing, in the second quarter, the top line is growing. The bottom line is growing. I cannot give you the numbers, but it's very, very positive compared to year on year as well as also in the last quarter. So in general, I think from the export side, if you look at, our dollar is at 72 level, so we are going to get benefit from the differential of amount from 68 to 72. Whereas also, even if the raw material prices have increased in certain, categories, there are also revised prices where the GST was higher, but we had to change the MRP where, it was applicable so that we get the benefit of, increase in raw material cost. In B2B segment in particular, we have increased our prices also. So I think, cumulatively, I see the net impact at the end of the year will be only positive. And while all these, taxation issues which are coming and also the increase in, import duties, it will also give the level playing field for the domestic players. So I see overall it's a very positive sign for the domestic industry.
What's your market share currently, sir? And does that also see a spurt?
Well, in general, I think the post-GST, we are seeing that our competitive edge has increased. So we see a great traction in our own stores, franchisee stores, and also in distribution network, we still do not that sign of growth because still, the market is struggling with the GST nuances in terms of e-way bills, etc., etc. And the smaller, players are, under some, kind of tax relief they have for GST. So that market is still settling. And I think once that settles down by end of this year, financial year, we will see traction in that particular segment also. But in general, our exports are growing, our B2B business is growing, and B2C, particularly in the retail, is growing. So overall, we see a better balance sheet going forward next year.
So just to get a sense from you, in terms of, the quantum of imports for your category, is that substantially high? And a 5% increment in duty, is that going to be a big deterrent for people who are anyways importing?
Well, let me put it this way, first of all, let me give you a statistic that we are importing nearly 25 crores of shoes every year from China alone. Whether it's Vietnam or whether it is Europe or Brazil or some other countries, even that data we do not have as of now. But China alone is selling us 25 crores. And I think we have to see it in a two-step approach. The 10 to 20 is a 100% increase in custom duty, and further 20% increase from 20 to 25. I think cumulatively, if you see, it's almost like 125% increase in the duty. So I think it's a merit for the domestic industry, and the average value of import is still very low because it's all under invoiced mostly. But I think as the dollar has moved up to 72. So that is also going to be a deterrent for, importing shoes into India. And people would rather prefer to now make in India, where a lot of incentives are also available from the government on new investments. So I think, these, even if it is smaller, numbers in terms of, let's say, aided duties, they will surely going to benefit the industry.
Got that.
5% increase is not a small amount. It's quite a good amount, actually.
Okay, so thanks for clarifying that for us. So a big positive for them. Mr. Gupta, appreciate you taking out the time. Let's go across now and hear from one more management regarding what the impact of the increase in import duties is for their sector. So we've got with us the management at Blue Star, Mr. B. Thiagarajan. He's joining in right now to talk about the implications for the company. So thanks very much for joining in. Do you see this as a negative for the industry, particularly considering that most compressors for ACs within the industries are any which ways imported?
Good afternoon. Thank you for talking to me. I consider it as trying to bridge the current account deficit. It is in order to strengthen the rupee. So between rupee and the custom duty, rupee depreciation hurts us much more. So therefore, because of the declining rupee, we had decided to increase the prices from 1st of October by 5 to 6%. Now, if the custom duty is going to come into effect, it is not going to be impacting us immediately because 3-4 months extra stock is available with us already. Now, by then, if the rupee is strengthening, it is not a big deal at all. And in any case, on the compressor, it is only 2.5%. So the government has to manage the rupee. That is more important for me. So custom duty decision is fine because we are investing in manufacturing. We are more of a manufacturer than many others. And fine, there are some components that are getting imported. That is part and parcel of the game. So therefore, I am not unduly worried about it. Next thing is we always anticipated this for quite some time. So we have our direction in order to indigenize, in order to go ahead and do backward integration, those we are on. I will tell you, my fundamental desire is that the industry should grow, therefore scale should give us some kind of and
right.
the impact should be kept healthy. So therefore, I am not at all worried about yesterday's announcement. Yes, it is a small thing that we should carry up in life.
No, Mr. Thiagarajan, if you can quantify it in any way as to how small a small dent this is, and any idea or rather any indication about the quantum of processors that you as a company would be importing, or are you manufacturing everything in-house?
No, we import the compressor actually. There is a 2.5% impact of that. Now, next 3 months of a time.
2.5% off, sir?
2.5% is the increase in custom duty
right.
as far as compressors are concerned. Okay.
Yes. So
now, if you net calculate, the impact will be passed on to the consumers. We are not going to be bearing any kind of a burden because when there is a reduction, we pass on. When there is an increase, we will pass it on. Okay. Therefore, if you do not pass on, that impact is not more than 5 crores of rupees in our case.
Annually?
Annually, rest of the period of this financial year, not annually.
Okay, rest of the period of the financial year?
Yeah, because 3 months stock anyway I have got, and it is only last quarter, whatever it is. And in many models are already indigenized. So therefore, yes, it is a pain, but the thing is in business you have to cope with this, right? By then, whether the rupee will be brought to 70 or below. That is always important.
Okay, that's, reading into the future whether or not the currency can come back to 70. If indeed it doesn't come back to 70, you said so far to counteract the currency depreciation, you've taken a 5 to 6% increment in prices. With this duty hike, you don't expect to see much of a change because you have 3 months of stock lined up. After 3 months, if the rupee doesn't go anywhere and stays where it is right now, do you see yourself passing on this duty hike further down the line and a further increment in prices?
You have to review depending on the pre-summer conditions, but even if it is not passed on, it is 5 to 6 crores of impact. It is not a big deal for a company of our size,
Okay, Mr. Thiagarajan, we'll leave it at that. Thanks so much for taking the time out and being with us and giving us that perspective. I reckon you don't believe, I mean, you know, but I don't think from his answers he didn't sound to put up either about the price hike or the impact on demand that would come in a result of this price hike too.
Actually, none of the managements that we've spoken to so far, be it JK Tyres, be it Liberty Shoes, be it the management of Blue Star, none of them seem too perturbed about the duty hike.
Yeah, so it's interesting as to how it is happening. Anyway, just the markets have just worsened a bit now. 78 or 79 odd points now down on the Nifty 50. The Nifty Bank about 300 points lower as well, and the Sensex about 235 odd points lower in trade today. Okay, now before we move any further, I think one thing that we want to highlight today is also the investor memo that came in from none other than Howard Marks. He's of course from Oak Tree Capital, and let's go across to our wall and just try and highlight what is it that he's trying to say via this investor memo. I think the headline of the memo is that too much money is chasing too few deals, and that is never a good case for investing because the risk appetite or the quality of deals that are coming in for the same price is obviously not the right. Not right. I think that's the key line. And then, of course, a number of instances that he's highlighted. Well,
you know, he's actually trying to put into perspective and trying to tell investors that whether or not the market is, you know, is having that froth at this current point in time.
Yeah. So the build-up.
Yeah, the build-up. Yeah. So we've had...
First he said, Devina, the significance of the number 10. So I'll take you through this. He says there that the 3 or 4 reasons, and he's just highlighting all of them. One, it's the 10th anniversary of the Lehman bankruptcy. It's 10 years for stimulus for the US markets and the 10th year of the economic recovery in the US. And then in that same vein, he said that never before in history has an economic cycle in the US lasted for longer than 10 years. That is not to say, sometime later in the memo he said, is not to say that this means that it will end, but there is enough evidence to suggest that there is a 10-year cycle is the maximum that has lasted, and therefore people should warrant caution here.
You know, he's made quotes and he's compared it to an auction where there is an interest in a particular commodity, and when there are more bidders, how the price of that item goes up without an addition in the actual value that that product can give the person. So he said in investing, the opportunity to buy an asset or to make a loan goes to the person willing to make the highest price, and that means accepting the lowest returns and shouldering more risks. Aside from that, he also says that when there are many would-be buyers and they have a lot of money, the bidding will be heated, prices paid will be high, and when that's the case, you won't get much return for the money, prospective returns will be low, and risk will be relatively high. Now, so if that's the case, I mean, looking at how the US markets have performed, he's talking about the 10 years that the markets have gone up. He's said, like you said, he said it's never before happened that you've seen such a long stretch of the market bull run, driven by artificial liquidity which has been pumped in at the lower rates. So he said liquidity in economies have been made available at artificially low interest rates. Money which was supposed to go into low and lower risky assets like your money market, your treasuries, your high quality bonds, because of the low yields being provided there, money has now diverted towards the niche markets where there are riskier assets. So in order to make that little more leverage in terms of return, so money has moved out. And effects of such flows, again going back to the first point, which is higher prices, lower returns, higher risk, and a weak security structure.
Yeah, so I think that's the sum and substance, the weak security structure and increased risks. Now, the key takeaways to my mind, odds are against the 10-year recovery continuing longer. That is one key point that he's making. And I think the key takeaway from the memo, while he's argued about a lot of other factors as well, and the fact that the US economy is not that bad, etc., and all of that, but on the timing front, he's saying that the requirements for a frothy market are fulfilled. I think that statement, to my mind, said it all about this memo, Devina.
You know, interestingly, he's also highlighted that in the last 10 years, your investment managers have not seen one instance, you know, of a correction or where there is a crisis or where there's a liquidity crunch, because all of that, you know, the central banks have come in a big way to support markets. So an investor who would in a crisis be a little bit more risk averse has not been able to do that because of the excess liquidity provided. So they're happy with the liquidity and they're now charged up to take a riskier bet and, you know, invest in niche markets and niche assets, which according to them will give them high returns.
Yep. So this is the latest from Howard Marks, and while he's not really sounding the doomsday scenario, he is pointing towards some caution warranted. Actually, he's been doing this now since the better part of the current calendar as well, but repeatedly the pointers coming in from Howard Marks' side. I know we in India might be thinking that we are already in the midst of experiencing that pullback. The US markets are probably not doing that, but you never know for how long will this last. So, well, this is one key thing that has come in from Howard Marks' side. Okay, our markets, they now focus back on them. About 1.25% for the Nifty Bank. Nifty 50 down about 0.7%. Good time to get in our guest on the show, Bala of Cash the Chaos, with us with his sense of the charts. Jeb, good having you. Thanks so much for joining in. This expiry notwithstanding, and that will pass in an hour from now, Jeb, how is the trend looking like for the next 30 days, for the next 60 days? For the Nifty and the Nifty Bank? Are there more downsides that we will see?
A very valid question, Neeraj. Let me take a minute or two to explain this. The last time when I was here, I said for the market to be outright bullish and the trend to continue higher for record highs, the market shouldn't have printed 10,929, which was the May high, which is the current resistance day high. But the market has done that. So given the fact that market is doing that despite global bullishness, and that is a reason, that's something to for us to do a lot of risk management, you know, and you got to be raising amount of cash, barring a few sectors, which are pharma, sugar, and base metals. These are looking positive. Pharma is looking outright bullish. So, you know, for rest of the anything in the rest of the space, you definitely have to raise cash. And the strategy here is to buy some puts at least below 10,500 level, because the worst case scenario here is such that the Nifty could drop to 9,700. That's the worst case scenario. You have to prepare for the worst and be ready. You know, if you are not prepared for the worst, you can have a lot of negative surprises. But if you're prepared for the worst and the market throws in a surprise, that'll be very pleasant. So always prepare for the worst and expect something positive. Okay, given that the situation, the Dow is looking like it's heading for 29,000. The Nikkei is looking like it's heading for 26,000 at least. And China is looking like it's going to go to at least 4,500 to 5,000, which could even be nearly doubling from current levels. So despite this kind of global setup, the Indian markets are not responsive or responding. I had even put out a note on Bloomberg.com saying that, you know, there's a heavy correlation between Nikkei and India, and India is likely to, you know, follow Nikkei to the upside breakout. So I don't know if that's going to come back, and the correlation is going to come back, but at present, the Indian markets are not responding. So we better do some risk management at current levels.
What about the bank Nifty, Jay? I mean, we've seen the performance over the last few days. We're just about holding on to 25,000 in tenterhooks, down 1.3% today. Is the outlook more bearish there?
Yeah, the bank Nifty is the weak spot. That is the sore spot for the market. And it looks like, you know, it's broken through some important supports which it shouldn't have done at all. And it looks like there is a little more downside there. But it's the frontline private banks which are actually strong, but rest of the space is quite obviously not looking good. So the 1/3 of the Nifty is actually very weak, but the rest of the you know, markets are relatively better off. But you know, the banking sector is slightly weak, looking like something like 24,500, maybe even slightly lower for the banking index.
Interesting. Jay, have you looked at the charts of some of these NBFC names, the ones that have fallen quite a bit already? And I'll exempt you, if I can use that term, from a call on India bulls. or, because that's in the eye of a storm. But some of the others and the way they have come off, so Canfin Homes and IFL Holdings, Edelweiss Financial Services, some sharp cuts into these names. These are not the epicenter of the storm per se. How do these charts look?
Yeah, quite. It doesn't need the charters to say that they are looking ugly, and Edelweiss, for that matter, is looking very bad, horribly bad. And it was in the works when it even went to the highs of about 330 plus. The highs were disagreeing with the momentum was actually disagreeing with the highs. It's not with hindsight that I'm saying this. It is plainly written out there. And if you look at something like an S Bank, that has got short-term downsides to somewhere close to 180. So even though that's not an NBFC, if you look at something like Repco Finance, that is looking negative. So not a good space to be. Relatively, you can just talk about relatively outperforming, but that's not the kind of thing you're going to do. You got to pay bills. You got to make money out of the market. If you are in a relative performance mode, that's for the fund managers to talk about. And yet the market dropped 20%. We did only 10%. That's not the kind of thing we want to do. We want to be making actual money.
Right. And according to you, how does one make that in the sense, like, if you have stock ideas, I believe you're liking a Deepak Nitrite and an Ajanta Pharma.
Yeah, Pharma is outright bullish. It's looking unblemished even after this deep fall, and it's going to be in the limelight possibly. And so if you look at the Pharma index, the BSE Healthcare Index, I had projected a level of 16,600 for this leg of the move. It's come there, it's correcting there. The correction is shallow. Even now, if you look at something like Biocon, that's making record highs. So this space is an oasis within the storm. So watch out. There is more upside to come through. Specifically, Ajanta Pharma for the short term is quite good. Takes a stop.
We lost you. I'm sorry, I think we lost Jay, Bala, but two ideas, Deepak Nitrite as well as Ajanta, a couple of names that he's recommending. Hopefully we'll repatch with Jay Bala and get his conversations going as well. But we got his sense. Now let's try and get a fundamental sense and a fundamental voice on the show as well. Dipan Mehta, member at BSE, joins us right now on the show. Well, somebody who's seen a number of these cycles and the impact that come out on these stocks. Dipan, good having you. Thanks so much for joining in. From how you are seeing the markets currently, does it look like a very ominous scenario, or do you reckon a large portion of the immediate damage is done?
Well, it's difficult to call at this point of time, and I've seen many such sharp corrections, and how deep these corrections will go, when it will bottom out, and what time period investors have to wait are all subject to speculation. This is not entirely fundamentally driven. You could understand a minor correction in the NBFCs and thereafter in the broader markets because of rupee depreciation or because of marginal increases in interest rates. But this kind of a sell-off which we have seen in the NBFCs and the collateral damage which has taken place in the rest of the stocks, especially some of the interest rate sensitives and some of the more economically sensitive sectors, is something which is difficult to get a handle on and exactly assess how the way forward is going to be. All that we can do out of the years and years of experience that we have witnessed such moments is just to wait out this particular pain. I know it is tempting to go out and buy, but till we don't see stability, till we don't see a reversal which is clearly identifiable in terms of higher tops and higher bottoms, I think investors should just retain their cash positions. Clearly the selling has exceeded what the fundamentals demand as far as a lot of scripts are concerned, but this is the nature of the beast, and while there are extremes on the upside, there are extremes on the downside as well, and I fear we are at one of those extreme points on the downside. So it's difficult to give a perfect handle on how these things will progress and how much time we need to wait out or when the actual reversal will take place.
All right. Just talking about, we spoke with Jer about some of these NBFCs and housing finance companies. What's your sense, Dipan? The pain here, is it likely to get prolonged? Because we are seeing, some names like an Edelweiss now sub 200. I mean, the stock was trading closer to about 300. From there, come off sharply, now at about 194. And a few other names to put in the mix. What's the sense there?
As I said, I think, these stocks have reached attractive valuations. But, if there is a liquidity risk, then all bets are off. Because in terms of valuation, in terms of, the track record, in terms of what the exact business model is and how it is able to generate compounded growth and compounded profits, all that is intact. It's just that people fear that these NBFCs, whether it is housing finance or microfinance or any type of funding which is done by an NBFC, just because they don't have access to low-cost deposits like banks, there's a fear that they will not be able to, get adequate refinance, and that may impact their potential to grow. That may compress the net interest margins, and there are many such other risks as well. So how that will play out is difficult to say, and it's not something which will get resolved in a day or two or so. Just yesterday, or I think 2-3 days ago, we did see these same companies which are being beaten to the pulp just now raise money in the CP, in the commercial paper market, at very fine rates. And going forward also, when you speak to the managements, they still claim that it's business as usual, and they are able to raise short-term money, long-term money at marginally higher interest rates. It's not that their AAA rating or their AA, whatever rating they have, which is more than investment grade, is being affected. It's just that they may be having temporary mismatch of liquidity, and that fear is difficult to gauge or discount for that matter.
But Dipan, just a follow-up to that, and a two-part question. One is the ALM is positive for a lot of the other names. Bajaj Finance is a separate kettle of fish wherein it's positive, but even for Edelweiss, the ALM is actually positive. So is this sentiment driving some of these stocks at valuations which are lower than what they ideally should be in such an environment? And therefore, should investors who have the gumption take advantage of that in some of the select NBFCs?
I guess you can, but each investor is different, and I'd just like to explain this a little bit. So, for example, in a portfolio, if there are hardly any NBFCs and you still have adequate cash and you can take exposure to the financials, then this is a good starting point to start investing in the NBFCs which we have missed out on earlier. And many investors have missed out on stocks like Bajaj Finance, Indiabulls Housing, Dipan for that matter, and Edelweiss and IIFL as well. These companies, the NBFCs per se, have been one of the biggest wealth creators over the past 3-4 years or so. So if an investor has missed out, not invested in them, then it's a good starting point. But I think many investors are already invested in some NBFC or the other, and more or less I think their allocation which they should have to the NBFC, which I think should be about maybe 15-20% in the portfolio, that is more or less been reached or breached. In such a scenario, putting more money, doing averaging, I wouldn't advise that, because I'm not certain that this sell-off has ended, and this is the absolute bottom for these NBFCs. As I said, if further bad news comes, then these stocks could correct even more. And in a bull market, there are no highs. In the bear market, there are no lows, and same thing applies to the NBFC stocks at this point of time.
Right. I know, Dipan, you just mentioned some time back that if you're sitting on money, probably just wait it out a little bit more. But for someone who probably wants to deploy money right now, where does that opportunity arise according to you?
As I said, I think it depends upon what the person's portfolio is. If you don't have allocation towards NBFCs, then by all means, those are the best stocks to start investing in, especially those associated with large business houses which have the capability to keep on raising funding, the likes of say Bajaj Finance or M&M Finance or L&T Finance, which have the Aditya Birla Capital, which have the backing of their industrial house to ensure that there are no liquidity concerns. So that's the first place to start. If you already are well invested in the NBFCs and the private sector banks and still are sitting on cash, then I would still say go for the consumption-oriented stocks. We've seen a major sell-off in auto ancillary, and some of the building material, appliances, and other similar stocks, not necessarily FMCG, But consumption-oriented non-FMCG stocks could be something like an Havells or even something like Jubilant Foodworks. Those sort of stocks also have corrected, and this is a good time to maybe a Titan. Could be a good time to get into such consumption-oriented stocks, assuming you don't want to buy any financials.
Okay, got that. Dipan, it was a pleasure chatting with you and getting your thoughts on the show. Thanks very much for speaking with us this afternoon. Dipan Mehta there with his thoughts on the market and a few pockets that he's liking. Before we go ahead and get Amit Harchekar to talk about the markets, let's go across to our usual segment, which is Chart of the Day. And we've been talking about how the markets have been edging lower with every passing day. But what has been the impact of this correction on sector valuations? Let's go across to Jayesh to find out. Jayesh, good afternoon.
Good afternoon, Devina. First, just to give you context of how I've arrived at this chart is if you look at the Indian equities in the last 1 week, that has in fact been the worst performer across the globe with a decline of about 2.5%, and there's no other index which has, or rather no major index which has underperformed this one as well. As for the Nifty valuations, everyone had been talking about lofty valuations. That has in fact the 1 year forward has corrected from 19 odd times to around 17 odd times. But if I have to extend that to the overall market, how does the picture look like? So I looked at all the Indian listed stocks which are tracked by at least 10 analysts and have 1 year forward estimates available for themselves. And what stood out was that the overall universe of around 216 odd stocks, the 1 year forward price to earning multiple has declined in excess of 3%. And this is how the sector picture looks like, notably that the energy sector stands out because that has seen its price to earning multiple go up in the last 1 week or so. Barring this, all the other sectors have seen a decline, right from industrials to communications, in the range of about 2% to 5%. Now, when I talk about the industrials, you have the likes of the infrastructure giants, so on and so forth, and you have technology, which has seen a sharp cut of about 5 odd percent. The technology being the surprising one because we have seen that this is one of the best performing indices among the sector indices that we have. So just to give you a picture of how the price to earning multiple has in fact been revised downwards in the concerns that we have had in the last week or so.
Got that, Jayesh. Thanks very much for that. Quick look at changes in the valuation post this decline. Let's bring in Amit Harchekar. He's joining us from Indus Genius Investment Advisors. Amit, thanks very much for taking out the time. Let's quickly run through your ideas on the index first, and then we take to specific stock ideas.
Well, I have a sell trade on both Nifty as well as on Bank Nifty. Nifty, the rationale is we are now seeing a build-up of short positions. Yesterday was the first day where we have seen open interest addition in Nifty futures by around 5 lakh shares. So now people have started digesting that the trend is down and they have started adding short positions. So we think now 11,150 would be a very good stop loss for your short positions for the next series. And we are expecting this downward move to extend towards 10,850 for October futures. Second would be Bank Nifty future. Here the rationale is we are expecting a sharp rally in dollar index, and that would also take USD INR towards 74 plus levels. So we are expecting weakness in financials. Here the stop loss would be 25,500 on the October futures, and we are expecting Bank Nifty to drift lower towards 24,500 to 24,600.
Okay, you've got 2 sell calls, individual stocks, and 1 buy call as well. 2 sell calls on LIC Housing Finance and M&M, and a buy call on Ultratech.
Yeah, see LIC again, what we feel stock had a very good support around 435, 440. That support has been violated with very heavy volumes, and right now we are expecting this selling to aggravate all the way towards 385, 390. So stop loss for your short trade would be at 440 on a closing basis. Second trade would be M&M futures. Here too, we had seen multiple support with M&M between 885 to 900. Now that support has been breached with good volumes, and even we have seen a major decline in Nifty Auto Index. So we now expect this slide to extend at least by 5 to 6%. So from a stop loss perspective, 920 should be a stop loss on intraday basis on futures, and our short-term target would be at 840. The buy call in Ultratech is based on rationale that Ultratech has reacted almost 60% from its intermediate highs, and we feel that becomes a very strong support in the near term. In fact, one should go long on Ultratech October futures between 4070, 4080. We think 3950, 3960 remains a very strong base for this rally to start, and we are expecting target back towards 4325.
Got that. I'm going to pull up a Yes Bank. We took a check earlier on. The stock was trading around 207. Now it's at 204. So, at the lowest point of the day for the counter. Jay, I believe you've given your views, but, we've got some queries coming in from our viewers on whether or not it's a good time to short the stock and what's the target price around this stock.
See, one should always focus on the risk that you're taking. That's yes. Downsides probably somewhere around 184. But where will you put this?
The line seems to be a bit patchy. I'm hearing Jay's voice off and on, but difficult. I think he was saying that you can look at targets of about 184, but the risk reward needs to be assessed properly. Amit Harchekar, can somebody initiate a fresh shot here?
Yeah, absolutely. What I think, as long the rupee remains under pressure, you will see underperformance from financials. And Yes Bank, since the stock is already going through a phase of good amount of long unwinding, I think your short trade would be with a stop of 215, and we should expect target of 184 to 180.
The Bajaj twins too, by the way, are down 3.5% down for Bajaj Finance. Finserv too looking soft, about almost 4% for both actually Finserv and Finance. Maruti Suzuki is back to 7601 as well. A lot of quality stocks are getting hammered right now. Tells you a story. Take a break. Hear out what Mihir Vora of Max Life Insurance thinks of a likely slowdown in credit growth and whether that could hurt consumption as well as growth going ahead.
It could possibly, though one always wonders what comes first, whether demand comes first or the financing comes first. But any kind of liquidity squeeze in the financial sector obviously does impact growth. We have seen a huge amount of growth in the NBFC sector, and we need to understand the reasons behind it. That has happened because they addressed a gap in the financing market. Public sector banks, especially in the last few years, have been going slow on their lending because of the NPA issues. And there was a demand gap in various segments, which the NBFCs were fulfilling. So I don't think demand is an issue. And as long as credit to these finance companies continue, I think growth should continue. I don't think there's a question of demand. There is pricing power in the system. And each NBFC has their own business model. So as long as the markets, the financing markets continue to function normally, irrespective of what the rates are, growth should continue.
Mm-hmm. For our markets, particularly on the index, the one-year forward PE is at highs of about 18 times. Is there a possibility of a PE derating, which is likely to come about here?
Yes, though the overall PE probably may not even demonstrate the kind of polarization that we are seeing in the markets over the last few months. As we've discussed in the past, it's probably 8 or 9 stocks that are driving the Nifty in the last 6 months. If you look at the wider indices and even the mid-cap and small-cap indices, they are actually at their lows. So to that extent, the overall PE is a misnomer. There is a bunch of stocks which is very expensive, but there is a much larger universe of stocks that has been really beaten out of shape, and probably there is value emerging in those pockets.
Interesting. Actually, I was going to ask that question. The divergence between the Nifty and the Nifty small cap is the highest in the YTD period than it has been since at least the data that we have calendar year 04 onwards. However, while there is value here, do you think there could be a protracted time correction in the small caps until things settle down? And if so, how long could that time correction last?
So it's a difficult one to predict the timing. If this if this credit market situation had not happened this month and the kind of panic that we have seen in the financials space had not happened this month, actually the Indian economy is rather showing signs of traction. So as long as we are able to get over it, probably we have already created a lot of value by marking down the mid caps and small caps over the last 6 months, and there is value available in this segment, I would say, as long as the Indian economy continues to grow at the rate at which it was already showing signs of in the last couple of months. We have seen some good data points on GDP growth, etc. And the crucial aspect, of course, was to see whether this good growth continues in the December and March quarter also. So I think consumption, etc., remains strong. It's an election year. Government will not let down on the revenue expenditure side. So to that extent, there are some levers for the economy to grow, and mid caps and small caps, because of their valuations having been marked down so much, do have begun to show some interesting valuations.
Good news, guys. Got a promotion and a damn good raise.
Congrats, beta.
Congrats, मेरी तरफ से भी.
From mama too.
वाह, raise? अब तो इंश्योरेंस पॉलिसी ले ले.
इंश्योरेंस? कौन सी कंपनी से लूं?
सोचना क्या? चूज वही जिस पर हो पूरा भरोसा.
वीरू, go for convenience. My company is online, quick and simple.
बेटा, but पॉलिसी समझाएगा कौन?
वेबसाइट पे सब है पापा. I can even call and ask.
क्लेम सेटलमेंट का रेशो क्या है? मेरी कंपनी का 98% से ज्यादा है.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
अरे पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC trending with times. 62 सालों से हर generation की पसंद.
When I started juicing to bounce back from a serious injury, I had no idea that it would turn into a passion, that would turn into a brand that provides healthy choices to millions of consumers. Today, my brand is a household name. I am Anuj Rakhian, and my story is a clean and a flavorful one. I'm the raw pressery guy, and I'm here to tell you my story only on Aegon's of Business.
Aegon's of Business never stop. Only on Bloomberg Quint.
Back with countdown right here on Bloomberg Quint. Bring up the European markets. 27 minutes to go for our markets to close. We're at the lowest point of the day, by the way. Conveniently below 11,000, very close to 25,000 for the Nifty bank. The world markets, not unhappy a place, but definitely not happy too. DAX, in fact, down 0.5%. The Dow futures, when I last checked the WIF function, it was showing a bit of red. For now, just about a flattish day, a flattish number. But let's wait and watch what happens here. Let's bring up some statistics from our market side as well. The market breadth and the advanced decline ratio should now come up on the wall, and look at that. That's about 1:3 in favor, or slightly worse than 1:3 in favor of the declines. The turnover should come up on your screen. Expiry day. The NSE cash volumes are now similar to what happened yesterday, but the FNO volumes are pumping up, expectedly so. But 17 lakh crores on the NSE FNO is not a small number. Just that because it's expiry, you'd probably expect these numbers to show up any which ways at about that number.
If you could quickly have the open interest change chart as well for you, we'll tell you where we are placed for the October series in terms of the kind of movements that we've been seeing. So as of now, it looks like the 11,000 strike has more predominant call activity, and on the 10,900 strike, that's where much of the put action is. But if you see below that, it's almost flat. So there's hardly any put action or open interest build up. And even if you see the distribution chart under 10,800, it's pretty empty. So if we actually take down the 11,000 mark convincingly, then it could be a sort of a free fall towards 10,800 and below. But that's what the market mood is like. But let's go across to Yash Upadhyay, who's joining us right now with a list of Fab 4 stocks of the day.
Thank you, Devina, for that. So the first two stocks on my list are the beneficiaries of the government's move to hike the customs duty. So first up, we have JK Tyre. That one is up about 1.5–2% today after the government hiked the custom duty on radial tires from 10% to 15%, and Dixon Technologies, which is up 4%, where the government has hiked the custom duty on ACs and washing machines from 10 to 20%, which is a big positive for the company. Igarashi Motors is another stock to watch out for. It's up almost 22.5% today. It goes ex bonus, and also it has snapped its 4-day losing streak. It has seen a good bounce back today, so watch out for that one. And Kesoram Industries, that one's in focus as well. It's up 4% today, with volumes coming in significantly higher at almost 4 times the 20-day average. Back to you.
Yash, thanks very much for that. A quick word from you, Jay, on a few stocks. If you're tracking a Motilal Oswal Finance, if you're tracking an Edelweiss on the charts, do these make case for bottom fishing?
Oh, definitely not. Definitely Edelweiss particularly not. And I will also comment about what Yash had spoken about JK Tires. Tire stocks in particular, I will say that they have made a medium-term top, use every rally to exit, and in fact even MRF is likely to drop somewhere close to 53,000 to 45,000. If you get a bounce somewhere close to 69,000 to 71,000, definitely exit MRF. They have made a medium-term top.
Okay, that's MRF, an exit on MRF there. And most of the tire companies looking a bit lofty right now. Amit, anything on a Reliance Capital? We've got a query from a viewer on the stock, if you track it.
Well, I think the stock has still scope for a further downside. In fact, the stock was attempting to form a bottom around 298–300, but that level has also been surpassed quite convincingly. Now, the next support zone falls in the zone of 275 to 272. So I would be again going short on Reliance Capital with a stop of 305. 270 should be a target on a short-term basis.
A couple of factors for Reliance Capital. One is, of course, the fact that in the entire NBFC space is coming off. Two, I think one of key personnel has moved out as well, and that should be impacting this stock too. Mayuresh Joshi of Angel Broking with us on the show as well. Mayuresh, good having you. Thanks so much for joining in. What is it that you guys are talking about in your meetings, Mayuresh, in the morning or the afternoon meetings when you're seeing NBFCs crumble the way they are? These were darlings 25–30 days ago. Obviously, the business has not gone lost, maybe slowed down for the next couple of quarters or maybe 3 or 4 quarters. But is the fall pricing in the pain?
So afternoon, Neeraj. I think a large element in terms of all the issues surrounding NBFCs at this point of time, I think the nervousness in terms of sentiments towards NBFCs has become sour. The second element, and as you're rightly putting it through, I think it's more to do with the kind of growth scare that these companies might face, and that is what the perception for a lot of investors on the street are at this point of time. The third element obviously is that as there is liquidity squeeze in the market, the not so well capitalized NBFCs will find it difficult to raise money. And even if they are able to raise money, that money will come at a very high cost. So how are they able to go into pass that through? I think it's going to be very, very difficult, and that obviously has a huge bearing in terms of offtake, both in terms of advances growth. and again, I think in terms of their overall AUM growth. So again, I think NBFCs, because of the cost environment remaining benign, and when you're talking about the interest curve actually moving up, the cost curve actually moves higher for these players, reducing their NIMs and spreads. So I think it's more a case in terms of whether they'll be able to deliver the 25-30% growth that they were delivering consistently with minimal stress on asset quality. At the same time, I think maintaining their NIMs and spreads. So I think it's more a case of growth compression happening, and you're right, over the next 2 to 3 quarters, which is probably causing jitters in the stocks. The other factors probably just accentuating the kind of pain that we're seeing.
Is there any, hiding safer haven sectors right now that you see, like a pharma, which seems to be, the flavor of the month with the kind of sell-off that we're seeing in high beta names? Do you see more money going in there?
So money, Devina, has flown into pharma over the past 3 or 4 quarters. And when a scenario like this erupts into the market, when there is uncertainty all around, I think defensives like pharma come at the forefront. Having said that, I think if you look at a lot of management transcripts, whether they're leading pharma companies or the tier 2 ones, I think the confidence is coming back, both in terms of the pricing pressures expected to come off, and the second element in terms of a lot of these pharma companies actually facing FDA concerns. Those concerns are ebbing off. So whatever they had done in the past because of FDA issues, the high compliance costs, or whether they were the elevated R&D expenses to create a complex pipeline, I think that will all start bearing fruit, and that is what the street is probably looking forward to. The third element obviously becomes the specialty pipeline, as I said, and a lot of companies have developed either ANDAs or FTFs and even the DMFs. So I think these exclusive filings is something which will alleviate the pain in terms of pricing pressure, at the same time give them exclusivity in terms of drug launches. So yes, I think pharma can be one space that can be looked at by long-term investors, and earnings, in my opinion, are only going to improve here on.
I wanted your particular opinion on Biocon from the space, vis-a-vis some of the other names.
So very strong portfolio, and what you've probably seen in terms of its biosimilars, whether it be pegfilgrastim, for which it has just received an European nod, Transozumab, I think all these drugs are multi-blockbuster drugs. So in that sense, again, I think the kind of inflection point in earnings from FY21 is going to be very, very substantial. Now, the other sub-segments of their business, small molecules, is actually picking up, though slowly and steadily, what they are probably doing even for their research arm. I think the research arm is functioning quite well. So again, all these factors probably combining together for Biocon at this point of time. One might really argue that the Malaysian facility and the kind of capex that they have done and the kind of depreciation that they'll book, I think the kind of fixed overheads for the Malaysian facility will still be a little bit of a dampener in terms of the overall earnings profile. But as that capacity ramps up over the next few quarters, and because of the other factors, including the domestic business, which also includes the specialty business, I think that should probably hold up the earnings for Biocon. So yes, I think it's a clear hold from our side.
Okay. There's a lot of red that we've spoken about already. Let's talk about some green on the screen. IT is having a good day. TCS, Infosys marginally higher, and oil marketing companies and oil and gas by and large, so BPCL, GAIL, HPCL, etc. seem to be doing okay for themselves. Amit, Harchekar, on the charts, any of these names, the gainers today?
Well, I would say right now the money is flowing to defensives, but what we think this outperformance, what we are saying, it could be only quite temporary. The moment market bottoms out again, money could flow out from these defensives and to again cyclicals. For Infosys, I would say 740, 745 remains a strong resistance area from where again you should initiate fresh short positions with a stop of 765. We are expecting Infosys to settle down around 690 to 700. TCS too, we are expecting 2200 to act as a major barrier from a positional perspective. So again, you should initiate short with a stop of 2280, and we are expecting in TCS to settle down around 2120 to 2100.
What's broken down, by the way, is Shrey Infra. That stock is down about 18%, and it's only cracked further in the last few minutes of trade. So big cash and large volumes out there. There is weakness in Balrampur Chini, again something that fell in the last few minutes even more. Was down about 3%, is currently down about 6%, so a small gash in the last few minutes of trade. And CG Power was down about 3.5%, is now down about 7%. Again, a steep fall in the last few minutes of trade. Some vertical falls there for some of these names. Jay, do you track any of these on the charts?
Yeah, don't touch Shrey Infra. It's still got further downsides. As far as Balrampur Chini goes, use this fall as a buying opportunity. And if you look at the sugar futures on the international commodity markets, trading at about 10 cents, 11 cents. It's got sizable upsides to come through. It got upside somewhere close to 15 cents per pound of sugar. So, whatever fall that's happening in the sugar sector is actually positive. Dhampur Sugar, Balrampur Sugar, and Praj Industries. These are excellent names. I'm expecting Praj to touch somewhere close to 150 to 167, Balrampur to somewhere close to 130, and Dhampur to about 200 230. So these are very strong names. I think the rally is going to be sustaining. So use all this negativity in the short term as a buying opportunity in this sector.
All right. Amit, I want to come to you with the Max financials. In December last, the stock was trading closer to about 610 odd. Now it's at about 418, a 200-point dip. Does that warrant an entry or probably just still stay out and for more pain?
Well, I think the stock has been consolidated into a running flag since March 2018. We think there is a possibility that this flag could be broken on the lower side, and the stock could settle all the way towards 360 to 355. So if anyone is holding this position from a positional perspective, I think one should try to exit on every rally. 450 would be a good area where you should exit your long positions.
Okay. 315, and while the pain continues on the indices, it's good time to get a check of what dealing rooms are recommending in the session today. Yatin Mota and Darshan Mehta are here with their channel checks. Good afternoon, both of you. Darshan, let's start off with you first.
Yeah, so overall there seems to be a lot of weak trends that are there in the market. Not too many recommendations that come in, but Maruti is certainly broken down. It's almost at levels of 7,500, and dealing rooms do indicate that there could be more potential selling pressure that's coming in. Yatin can throw more light. Probably what we've also heard is in terms of some discounts that are being offered, but Yatin will talk more about that. But Maruti certainly looks weak. The other sector is, despite a decent start, CEAT has managed to slip into the red, trading at a fresh 52-week low. There is heavy selling pressure by some of the institutions, which probably will continue on CEAT. So CEAT is looking weak. And on the flip side, Titan is something that has managed to rebound in today's trade. Some of the large domestic funds are recommending to accumulating this counter. The counter has had a big drop over the past few weeks. They believe that most of it is priced in, and they're recommending their clients to start accumulating Titan. But Yatin, what have you heard?
Well, as far as Maruti is concerned, it's a fact, and I called up a few dealerships in Mumbai, and they have spoken about 5,000 rupees of corporate discounts and 15,000 exchange bonus for models like Baleno. Of course, it has never happened that Maruti has given any discounts or any kind of exchange bonus for models like Baleno. So this is probably the first time that they're doing it. Of course, this is also to do with the seasonality because, post Ganesh Chaturthi, we have the Shraddhs coming in, not those auspicious days to, purchase new cars. So probably in that slack period, the company is trying to look at some discounts to push sales. Shouldn't be taken that negatively because it's a slack month. But let's see how really does the trend continue in terms of discounting, because that will be important to see whether or not this is a seasonality related discount or really is there some pressure coming in on the sales for these kind of models. Of course, in trade setup, we have the dealers which indicate that they are looking at weaker than expected rollovers on the stock side. I'm not talking about the index side. So stock rollovers have been weaker than expectations. If you look at the short-term support, dealers are indicating that 10,950 is one support zone that they're looking at for intraday trading. So this is one important level that dealers are watching out for at this point in time. And of course, they are remaining quite selective on the stock trading side. As far as dealers are concerned, Titan is something that they are recommending as a BTST, a trade based on FNO trends. Darshan also was pointing about the same. And Adani Enterprises, the stock rollers have been quite healthy, and dealers do indicate that HNIs are quite aggressive buys in the counter today. 4% up for that one in such markets.
All right, Yatin, thanks very much for that. So that's what dealers are saying this afternoon. Yathan highlighted Titan. And Mayuresh, I want to come to you with Titan. What does one do here? I mean, we had a CLSA report some time back, pushing target prices lower all the way up to 720. The stock did dip post that, but now looking a bit stable post clarity on the gold import duty and the overhang of that going away.
Yeah, so I think the duty structures have been tweaked and that does not create any negative impact for Titan. The second element obviously has also been the kind of forecasts that the company had given before this quarter, but now the company is saying post the con call that sales should normalize. You're probably seeing the wedding season come back with a bang during the festive season, and that again should have a huge say both in terms of the wedding jewelry of Titan as well as the studded jewelry. So the kind of expectations that one had in terms of a 25-30% top line growth, if that probably gets normalized to around 20-22 odd percent, I think the kind of fall probably captures the kind of earnings degrowth from an immediate short-term perspective. But at the same time, I think as the management is reiterating, if they're able to probably deliver 25% for the remainder of this fiscal, I think the growth prospects should come back for a qualitative stocks like Titan. Again, from a balance sheet perspective, very, very healthy balance sheet. You've got ROCs in excess of 29 odd percent. And the general business environment in terms of the organized sector and organized players like Titan doing well over the next few quarters and years, I think that should be something which should give earnings support as well. So the other part of the divisions apart from jewelry, I think the watches division has been doing well. The margins there should probably sustain. The eyewear and precision segment probably is a struggler, but again, I think the contribution to EBIT is not that significant. So I think I retain my positive view on Titan. I think the pain can be there from a short-term perspective, but the longer-term outlook obviously looks very, very sanguine.
All right. And Edelweiss now is down 12%. The stock's trading at 188. It is a bit interesting to know why the stock has been punished to that great an extent. Because, up until now, the earnings performance have been sanguine. 24 straight quarters of profits that the company has been posting. I mean, while obviously there are concerns and pressures, and Rashisha himself said the next 3 to 4 or 6 months may be challenging, but from a level of about 280 to 90 to about 180, a 100-point cut in a matter of 3 or 4 months.
Yeah, it's been fairly steep, and you're right. I mean, this is probably one of the well-regarded NBFCs, but we've seen the same happen to Bajaj Finance as well, from price of 2985 to the current prices. So a lot of these names, 30-35% cuts that have been the order of the day. Just that, yeah, Dina is right. The magnitude of fall in Edelweiss has been just rather very, very strong. Well, just before we start wrapping up the markets, 9 minutes left for markets to shut shop. Let's get in the closing strategies from our experts first. Jay, before we thank you, would you recommend a closing strategy for, actually it's not the weekend, sorry, for tomorrow's session?
Yeah, we're hoping it's the weekend and the market will close. So yeah, Lupin is looking pretty interesting at current levels at 900. It becomes a BTST. I would place a stop below 893 and expect it to open somewhere about 910, 915 tomorrow.
Okay, a BTST in a scenario like this, interesting. Jay Bala, his call. Amit Harchekar, your top closing strategy?
Well, we think today SBI has breached the expanding wedge pattern below 270, and now the stock has a possibility to move towards 255. So SBI would be recommended for a short with a stop of 280, and we are expecting it to move lower towards 255.
Okay, interesting. What else? I think Indiabulls Housing Finance, marginal recovery there. Maruti Suzuki, 3.5%, 7590. We spoke about discounts there. Mayuresh, you may have spoken about Maruti individually, but these large cap auto names on the index, the four-wheeler names, Maruti, Tata Motors, and also throw in a Mahindra and Mahindra, which is probably the more resilient out of the three right now. If you had to choose one, where would your preference go and why?
Again, I think it still remains with Maruti, Neeraj, at this point of time. And yes, I think the dual concerns that is probably surrounding the auto industry, I think with interest rates moving up with the kind of slack period that you're talking about because of Shraddh, I think the monthly sales numbers are going to be a little bit disappointing. But a large element in terms of all these companies pushing through, giving discounts, I think those factors might play out from a short-term perspective. The other element of input costs also moving higher, whether they'll be able to compensate that by passing it through fully in a scenario where I think the inventory build-up might happen. I think that is something which is causing a little bit of a jitters from a short-term perspective. But my own sense is that as the festive season comes around and as the demand normalization takes place over the next few months, I think Maruti specifically with its leadership position, the kind of demand that it has got across its variants, I think it should stand up pretty tall. Even in a scenario where interest rates are moving up, the buyers might delay or defer their purchases for a few months, but the buyers who wants to buy a four-wheeler, I think a 50-60 bips increase, I think is not something which will influence his decision or roll back his decision. So volumes might get affected from a couple of quarters perspective, but I think it should revert back to mean over the medium to long term. So yes, I think any significant decline, I think the earnings trajectory is still expected to remain strong. But this decline probably gives a better entry point because valuations from a forward P actually contracts, making some amount of comfort from a valuation level for long-term investors.
All right, Mayuresh, we'll leave it at that. Thanks very much for joining in. Neeraj, in fact, looking at these price performances, it just makes me go back to what Howard Marks said about the kind of froth that's there in some of these names. And it's basically, for most of these banking financial stocks, there was money that was going in. It is that commodity where there are a lot of bidders, a lot of people wanting to own the stock, causing it to get so heated up at that point that the higher you pay for it, the more risk you're taking on board, and the value of that stock in your portfolio may not be that much of an add-on.
Yeah.
And whether or not that risk bubble is now, has taken the prick and it has burst is something that...
I think the only question is whether or not you trust some of these companies which have followed these fair lending practices in the past to know their onions and price in some NPAs, yes, but not a really large bad book and not a really big compression of margins. As Shraddha was talking in the morning, the ALM is positive for Edelweiss. So their assets are maturing faster than their liabilities, and therefore they will not have a material impact really on the refinancing portfolio too.
But if you see the movement of Edelweiss and the pace and the tenacity of the price rise of the stock itself, from a level of 170, 180 that it was at a year back, the stock suddenly shot up towards almost 300. So the pace of that move and the want for that stock, it created probably a little bit of a hype around it, and everyone wanted to own an Edelweiss, which probably drove the prices to that level.
Yeah, but the question is just one. My little two bits that it's now with this fall trading at around 2.5 times price to book. Now, in a scenario like this, it is not terribly cheap, but it's come off quite significantly from the valuations that it used to trade at. Not to say that there can be more downside, but now it's no longer expensive. That's the limited point I'm trying to make. This correction has removed it from the expensive list to a not expensive list for sure.
In fact, the other one, that's Yes Bank, obviously keeping aside the succession issues and the overhang around Rana Kapoor, the valuations now, I mean, the stock trades at 1.4 times versus the historical valuation about 2.2, 2.3 times. So, if you look at these stocks, but they have their own inherent problems. So,
yeah, I guess so. But looking ominous for some of these names.
Yep. Yes Bank now at 203. A Lupin today stands out. The stock's trading closer to 900. This is probably, along with the Biocon, withheld its position in this recent downturn. Anything on the charts for Lupin, Amit?
Well, I think the stock has already formed a strong bottom, and good trade would be trying to accumulate this stock on a dip towards 870, 880. Because major long positions from a 6 months perspective has been built with an average price of around 795 to 800. So one should buy at around 880, and we are expecting target somewhere around 950 to 960 from 1 to 2 weeks perspective.
All right, gentlemen, just stay on. We're about 2 minutes away from market closing. So I'm going to quickly toss it over to Neeraj, and he'll highlight all the moving parts on the index for us. Neeraj.
Yep, thanks, Devina. Well, off the lows, about 0.5% lower for the key indices. Nifty Bank about 1% lower. Now that the mid caps and the small caps have had such luck, they would have been reeling under pressure for sure, and the market breadth would be negative. We'll come up the mid caps and the small caps in just moments from now, but essentially reeling under pressure. 2.5% for the small cap index, 2% for the mid cap index. This, I think, takes the Nifty small cap index down almost 29% YTD. What's moved on the index? Not too many strong gainers, save for Bharti Infra and a couple of IT names like TCS and Infosys. Yep, and Ultratech out there, but that's about it. Not too many other gainers otherwise, but look at the losers. Yes Bank is down 9%. Indiabulls Housing 5.5%. Bajaj Finance and Finserv have corrected about 4%, and this takes the correction in Bajaj Finance overall to circa 25-27%. Maruti about 2.5%. Tata Motors 2.5-3%. Axis Bank about 3% as well. ONGC, Mahindra and Mahindra are amongst the other names. So autos and financials, essentially the rate sensitives, which are reeling under pressure in today's session too. What about the mid-cap end of the market?
Well, like you already highlighted, Neeraj, the indices, the mid-cap index and the small-cap index themselves are down heavily, more than 2% apiece. But individual stocks are probably causing a little bit of pain and damage around themselves. You've got a Shrey Infra, which is down towards the end of trade, was down about 17-18%. The start of the show 1 hour ago, the stock was down about 14%. So I guess probably coming back to those levels. Indiabulls Real Estate is the other one that's witnessed pain in the session this afternoon. The stock is down 11.5%. A deep cash coming in sometime during mid-afternoon and carrying it down all the way towards the lowest point of the day. Stock's at 100 rupees now. And yield-wise, the stock we've been talking about at 188, 189 now, 11.5% lower. Canfin Homes, a detrimental move in today's session. It's down about 8.5% too. Max India, you've got Vodafone Idea, which is lost out in trade today as well. Max India is down 8.5%. South Indian Bank's down 7.5%. Among some of the gainers, you've got a Prestige Estates from the real estate pack, which is doing okay for itself in a falling market, up about 8.8%. So that a high point of the day is where it's shut shop. Adani Enterprises is moved up. Bata moved up on those import duty hikes, pushed up to about 25%. Bata's up 3.5% at close. KEC International, that also is a stock that closes with gains of about 4% near the high point of the day. Delta Corp and Bharti Infratel are a few other names that have closed with gains in today's session. But at close, the Nifty as well as the Sensex, trading with losses. Nifty down about 0.6%. Sensex also down a similar amount.
End of the expiry, and if you can actually get the expiry moves from the beginning of this expiry till now, and how has the performance been, if you can get that performance up and about. The underperforming IT names, some pharma names out there, but the cuts and the red on the screen is just astounding. The quantum of cuts in this expiry have been really, really large.
So if you saw the Nifty performance, and we kept raving about the Nifty performance, YTD performance, and how it's beat most of the emerging markets. At the start of this expiry to now, it's lost half of that already.
Yeah.
Shaved off because of these larger cuts in the banking names. And SBI there being a big one, Maruti being a big one, about 17% given up on Maruti.
Yeah, and the auto names out there too, and Yes Bank. Well, no surprises, Yes Bank and Indiabulls Housing Finance are amongst the principal names, but that's the wonderful part about this, or not really wonderful, but an interesting part about this, that blue chip names have come under some serious pressure, with Bajaj Finance and Maruti Suzuki right up there, maybe even an SBI thrown in out there. Mahindra and Mahindra about 11% too.
Turnover.
Well, interesting, yeah. Turnover should be high, Devina. I reckon that, 18 lakh crores. Cash market, 41,000 crores. We've been now getting used to these numbers.
Yeah. But for expiry, actually, this number is not too high. 18.8 lakhs. We've seen a higher number on an on-expiry day when the markets have collapsed. But let's see, that probably could be showing up in your rollover numbers, because at the start of today, when the Nifty rollovers were around 42%, that was still lower than the last few months, 3 months average of 48%. So on the index as well, the rolls were lower compared to average. But we'll have to wait and watch and see if they caught up towards the end of trade or no. But the options, futures and options turnover still seems to be a bit of a laggard.
And maybe getting distributed now over the preceding 2 or 3 days. I think I've heard a number of market participants say now and they're not waiting for the expiry day but doing it a couple of days before as well. But yeah, we'll talk about the roles tomorrow morning, I'm sure. Just one last bit on the contributors for today's session. And yep, rate sensitives all across here doing the damage.
TCS is your top gainer, 13 points odd, not nearly enough to support the index, and Reliance Industry, a meager 2 odd points is what it's added for being that heavyweight that it is. But end of the expiry, Jay, just a quick word from you. As we step into the new series from tomorrow onwards, is there any particular theme that you would like to follow?
Yeah, stick to pharma, stick to base metals. China is going to rally big time, and that's the reason why you're not seeing the metal stocks take a big dip. And that when China rallies, you'll see big support for base metal prices, and because of that, Vedanta, Hindalco, Tata Steel, they will all start to gain higher. So as far as Nifty goes, the short-term setup that's looking like the market is going to form a triangle, and there's from today's low, probably there's going to be another push somewhere closer to 10,100, but short of it. And then post that, there's going to be a final decline below the Friday's low of 10,866. But if that's not the case, the market needs to take out 10,100, and probably we're going to see a 2% day higher. If that happens, there's a good possibility that 10,866 low of Friday is going to stick, and that's going to hold. And we're going to look for the possibility of a bad trap.
Amit, what about you? Your thoughts?
Well, my sense is still there are a lot of risk on currency front, though RBI is trying to manage rupee at around 72.9. But if you see internationally, dollar index has formed a very strong bottom around 93.7, 93.8. And we think there is a possibility of 2.5% rally in dollar index. What we believe that would be the driver for rupee hitting 74.5. So we think this market would be into a very supportive position once you see dollar tops in the near term. Till the time, we think commodity would be a sector where you should be shifting focus towards. If you see cement stocks like Ultratech, Ambuja Cement, we have seen very good long build-up despite so much decline in this market. So that should be the area where you need to add up long positions. Financials, we think still a lot of selling is due, not from an index perspective. So the bank Nifty could only correct by 1 or 2%. But a lot of PSU banks, because PSU bank index has broken a multi-year support, there we can expect a slide of 10% more. So SBI could settle all the way below 250. So we think there are more pain for market in the near term. Overall, if there is a rally, it would be only from a Nifty perspective. I'm not talking from a very short-term perspective, but if you see a recovery in the markets, you will see small cap and mid cap turning quite a bit laggard in the near term.
All right, gentlemen. We leave it at that. Thanks so much, Jay and Amit, for joining us with your views and sharing your opinion on specific stocks and the index with us. Well, on that note, this is a wrap on Countdown from Neeraj, myself, and the entire team. Thanks a lot for watching.